Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hi, welcome back to the Investing Podcast. My name is Ben Nye. I am a senior equity analyst here, and today we're going to review Disney's quarter. Before we get into it, just wanted to give a quick shout out to our No Shave November campaign. We're doing it to raise money. All the proceeds go to the Movember Foundation, and that promotes men's health. It's, as Andrew likes to say, dudes helping dudes help dudes. So you can donate to me or to my personal campaign on my page, or you can donate to the team, but you probably should do it to my page, because that way I win our little internal competition. Andrew's in the lead right now, so I have some work to do to catch up to him. So quickly going through Disney. Disney reported last night. Obviously this has been a pretty crazy week with the election and everything going on with that. But companies still continue to operate, businesses still run, sun still goes up, sun still sets. The world continues to move on, and that's no different at Disney. So they reported earnings last night after the market closed, and the initial reaction was down. People did not like what they had to say. They didn't like the fact that the media networks was not as strong as they had expected. Media networks, of course, includes ESPN, and especially they didn't like the fact that EPS missed expectations, and was actually even below the lowest analyst expectation. So Disney reported $1.10. Street consensus was $1.15. They also reported revenue of $13.5 billion, they reported revenue of $13.1 billion, which missed expectations of $13.5 billion. So not a good headline report from Disney. And so you saw them trading, I think they closed in the 94s last night, and then they traded all the way down into the 92, even 91, high 91s quickly in the after-hours session. But then people started to listen to the conference call, and they listened to some of the commentaries surrounding the call, and they realized that Disney is still the Disney of old. They're still a robust organization that continues to innovate and continues to grow. It may not be the juggernaut that people thought last year when they were reporting record earnings, but there's still an important company. And there are a couple. So I wanted to go through on this review of their earnings, kind of segment by segment analysis of exactly what they did and where that stands relative to expectations, especially when you incorporate the outlook. So for example, if they reported a weak number but the outlook was very strong, I would be less inclined to hit them hard, because it was just one quarter. I'm more focused on what are they going to do over the long term and what the path forward is, because investment gains are made at inflection points when there's an acceleration in the trajectory of the business. So if you can actually buy it on a weak quarter, if you have a view that that's going to change and inflect, then that's actually a good thesis to buy on, and then your thesis is proven right when you do see that acceleration and you see revenue grow. So that's kind of how I approach looking at a quarter like this from Disney. So a few segments. We'll start at the top. We'll start at media networks. So media networks, I'm obviously not a media guy because I just turned my back to the camera. But media networks incorporates both ESPN, which is kind of the cable business, so we'll just call that cable. And it also incorporates the broadcast business, which essentially is ABC. So Disney owns ESPN, it owns Disney Channel, it owns Freeform, and some other properties as well. And it also operates ABC. So we can put broadcast here. So the way I'm just kind of wanted to simplify things just for clarity. Sometimes that's why models exist, to simplify things and make it so that you have a better idea of, what am I actually looking at? What's the big picture? What's a 30,000 foot view? So here I'm going to give them 1, 2, or 3 stars based on how well I think the business is performing and what the outlook is. So we'll kind of just average these out. So cable incorporates ESPN. ESPN has been seeing a great number of declines in affiliate revenue. They have also seen declines in ad revenue. So now let's look at why the causes for that happen in this quarter. So there are a couple of reasons. First is ESPN was competing against the Olympics this year. They did not have Olympic rights, so they were competing against a huge sporting event. And who's going to watch ESPN when the Olympics are taking place? So that was a very tough quarter for them in that regard. Second thing is, there's a secular trend. It just seems like fewer and fewer people are paying attention to NFL, and you're seeing NFL viewership decline on many levels, not just at ESPN, but also at NBC and CBS and Fox. All that viewership is declining. Third piece, they are seeing higher costs for their merchandise. So in this case, the merchandise is the sport product. They call it inventory. It's what live coverage do they have. So they just signed a new deal with the NBA that goes through 2024 to 25, and that's increasing the content right costs for them. So when you allocate that, that's a higher cost of goods sold, weaker margins. So not a great quarter for ESPN. Bear in mind, they're also competing against all the focus on politics with the election. So it's going to be a tough quarter anyway. The key is that in the conference call, CEO Bob Iger said, and he's been up front about this. Last year he was saying that we do see some headwinds and we do see some losses in ESPN subscribers. Last night he came out and said we no longer see these the causes of the headwinds for ESPN occurring to the same extent that they were. So if the causes are reduced, now he actually says, and I quote, "We're bullish on ESPN." So if management's bullish, they're seeing a lot more than we are. So ESPN potentially on an uptick. So I'm going to give that a 2. It was a bad quarter, but a good outlook, so I'm going to average out that to 2 stars on the cable. Broadcast continues to be really sound. They did have the benefit of election coverage, more people watching ABC, higher ad revenue, more people putting money into advertising. So that was a good quarter. They're not seeing an acceleration, they're not really seeing a deceleration at all. So I'm just going to take the quarter for what it was on broadcast, and I'm going to give that 3. However, as cable is a much bigger piece of the media network's pie, I'm going to give that 2 stars. So kind of right in the middle relative to where expectations were. Moving on to studio entertainment. This is what people think of a lot when they think of Disney. They think of, well, what movies is Disney putting out? And this year was just a phenomenal year. They had Finding Dory, they had Zootopia, and they had, of course, Star Wars. Star Wars The Force Awakens was just a juggernaut. Everyone knew it was going to be a juggernaut. Everyone knew fiscal year 2016, which ended last month, was going to be a phenomenal year. But the path forward is actually relatively weak, because when you're competing against those, you're all of a sudden saying, we're not going to see that same type of growth in fiscal 2017. We did say in fiscal 2018 we expect to resume a healthy growth trend, and that fiscal 2017 will be an anomaly. However, in my experience, it seems that people tend to focus on the here and now, especially when there's bad news. So I'm only going to give studio 1 star. Again, pretty much expected, but there's the path forward is not great. The next piece with Disney is the parks. So the big news for parks this year was the opening of the Shanghai resort. The Chinese love Disney, they love Disney products. Similarly, they love KFC, they like Nike, they like Apple. These powerful American brands are actually very strong for the Chinese consumer. So Shanghai was just incredibly hyped, and Disney actually thinks that they're going to break even next year. Now this quarter was somewhat weak. They were comping over an extra week from last quarter they had from last year. Hurricane Matthew shut Walt Disney World down for a day and a half, which may not seem a lot, but that affects you by $40 million in operating income. So there were some weaknesses in the quarter for the parks. However, I am bullish on Shanghai. Management is bullish on Shanghai. They're able to continue to push through price increases, which is just phenomenal to me. I mean, it is a magical place. So parks, I'm actually going to give 2 stars because I think the outlook is good, but the quarter was weak. So I'm going to give 2 stars. Another thing that I want to talk about when it relates to parks is the impact of the election. Many people, restaurants that I follow, tourist places that I follow, say that things often really decline in the month leading up to a presidential election because there is that uncertainty. Subsequent to the election, people realize that the world has not changed and they start buying again. So I think that also played a role in the relatively weaker quarter in parks. My view is that ameliorates and picks up again next quarter. Last piece in this kind of pie we're building is the consumer product division. And this division has, this is all the products that you see. This is the Elsa dolls. This is the Marvel's action figures. This is the Star Wars products. And now that Frozen is very slowly starting to die off, Finding Dory was able to take up some of the slack, but not all of it. And then Star Wars, it's been a year since the movie came out. So that was relatively weaker as well in the quarter. So it wasn't a strong quarter. Obviously, it's very dependent upon what films are being released. So it's kind of tied into studio. However, so for that reason, I'm going to give the consumer product division 1 star. Consumer products are a relatively small piece of the pie. So overall, if you're looking at media as kind of the biggest, studio and consumer product, not so much. Parks is kind of a middle ground too. I'm going to give the overall quarter and outlook for Disney 2 stars. Now, I know that's kind of half pregnant. I'm neither extremely bullish, I'm neither extremely bearish. But the point being, the outlook for the year was not fantastic. They say only modest revenue growth. I think street estimates may have to come down. However, I think a lot of people on the buy side have already priced that in. Everyone knew that there weren't going to be that many movies coming out relative to this past year. They do have a Cars launch coming out in the middle of next year. That should boost growth. So path forward for Disney still looks robust, but the immediate term Q1 looks relatively weak. Another point that I need to make on media and parks actually, is that for parks, the holiday is more in January this year than it was last year. So you're having a lot of visitors to the parks coming in January rather than December, which makes the quarter that ends in December relatively weaker and the quarter that ends in March relatively stronger. You also have, for media, last year all 6 games that Disney had for the New Year college football games occurred in the December quarter. This year, only 3 of them are occurring in the December quarter. So again, Q1 weaker, so fiscal Q1 weaker, December quarter weaker, and then March quarter stronger. So again, this was not a great quarter. Next quarter isn't going to be great, but then I expect to see a bit of an uptick as we progress through next year and then also into 2018. So that's my view on Disney. We do own the shares. I am not chasing it higher personally here. I would be very interested if it got back into the low 90s. I think it's a very robust company. I think there's a lot of things that it's doing right, and it's just run into some macro headwinds. But with any big company like this, you do have cycles, and I expect that they'll start to pick up on their next uptick sometime in the middle of next year. Point is, you got to get in front of that if you want to own the company. I appreciate you tuning in for the Investing Podcast. We also have a lot of election coverage that we recorded. Some views. We'll be coming out with more of that based on the cabinet positions in the coming weeks. I encourage you to follow that. You can always follow us on Twitter, send us a message. We'll send you a sticker, some other paraphernalia, and appreciate you for watching. Thank you.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.